Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we're going to dig inside the big business stories impacting Wall Street and the global markets. Each week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we're going to discuss how Chinese AI startup DeepSeek challenged Silicon Valley's assumptions about the cost of artificial intelligence. Plus, why shares of JetBlue Airways took a hit last week. But first, a look into corporate earnings from one of the largest wireless carriers in the U.S. T-Mobile reported fourth quarter results that beat analyst projections, and the results were driven by growth in wireless subscriptions and home internet customers. For more, guest host John Tucker and Paul Sweeney were joined by T-Mobile CEO Mike Sievert, and they first asked Mike for his take on the company's most recent earnings.
We're just consistently outperforming expectations, and that's what the market looks for in a business like ours. We're taking share, we're growing, and then across the board, we beat expectations. We just finished the strongest growth year ever in our history, and that's saying something because we have a storied growth history in this company. And a lot of people wonder, is the big growth, run behind us? And we just demonstrated yet again, no, it's not.
It's hard for me to get really excited about my mobile service provider, but your customers, it's like they're in a cult. What's the secret sauce? That's my softball question.
Our corporate values start with this basic idea: love our customers. Give them more, ask less of them, and they notice. That's just a huge part of our brand. And we have this thing we do called T-Mobile Tuesdays, where every week customers come to our T-Life app, which has 50 million users, and they engage to find out how are we rewarding them this week. Do you know what this week's was? We gave away a Shack burger, like the world's best burger, for free to every single T-Mobile customer.
It's free Netflix, too, if you sign up.
Absolutely.
So, Mike, you're in a competitive business. I think about the wireless business. The barriers to change are pretty minimal. Churn is always an issue. Your competitors are deep-pocketed. They're good competitors. Is it just you guys switching customers all the time, just for deals? Talk to us about the churn for your company, your business.
Well, churn's at historic lows across the industry, not just T-Mobile. We just had our best churn year ever. So people aren't switching a lot. When they are switching, the net share takers T-Mobile. So this is a great trend. I don't need for others to fail in order for us to succeed in our business. This is a great neighborhood. We just happen to be the best house in the neighborhood. And so we're outgrowing everyone, but this is a healthy, vibrant sector. Everyone's growing and making money. I think that's great. Part of it is people can't get enough of the service that we all offer. At T-Mobile, we just guided again to a big year of revenue gains per customer. And that's not because of pricing. It's because customers are self-selecting up our rate card to our higher priced offers because they see the superior value and they want what we have to sell. That's a great dynamic, not just for T-Mobile, but for the industry.
The growth strategy is organic or M&A or what?
It's organic, principally. I mean, we do have a number of M&A deals in the pipeline that we're intending to close this year, centered around fiber, centered around other add-ons. We're also in acquiring a cellular company, U.S. Cellular. So, but by far, the growth is an organic growth story focused on taking share, adding revenues, deepening relationships with the existing customers that now number well past 100 million.
Some of those I don't understand, like outdoor advertising. What does that have to do with your business?
Yeah, we just announced the acquisition of a company called Vistar, and we're a $1 billion advertising support company already. So this is a significant business for us. We call it marketing services for marketers by marketers. T-Mobile is a very famous marketer, and marketers want services from us. So we provide that already. But our T-Life app, part of what it does is it asks customers by the millions, whether they would like to opt in to make their digital life better and their advertising more relevant. And then we can use data to provide marketers with an ability to put advertising in front of customers that they will actually appreciate. And our dream with place-based marketing, outdoor marketing, that's the Vistar acquisition, is to do that for the first time ever in outdoor advertising. So that for the first time, outdoor advertising, place-based advertising, can become an addressable market.
Yeah, it's interesting. I love the outdoor business. You can't switch channels on that. I took all those companies public back in the day. Apple, Mark Gurman, Bloomberg News. Apple has been working with SpaceX and T-Mobile on Starlink. What is Starlink?
Okay, so this is the ability to connect your mobile phone directly to satellite service. This is a huge breakthrough. We announced our intention to partner with SpaceX over 2 years ago, and now finally it's coming to market with an opening of our beta a couple weeks ago. We're bringing on thousands of users, and soon, way more than that. We're going to throw the doors open on this thing. If you can see the sky, you're connected.
You
That's
don't
our
have to
vision.
point the iPhone at the...
That's
right.
correct. These are low Earth orbit satellites, so they're easier for your phone to find and vice versa. But this country, you guys, has 500,000 square miles uncovered by any cellular network. And it's a massive part of our landmass, and we're about to close that coverage gap.
Okay, so if on my bucket list is a trip to the South Pole, I don't need cellular service down there. I could just use a T-Mobile, iPhone, Starlink.
Well, I'm going to have to check on how good the LEO coverage is. But one of the things you point out, and very quickly to follow our terrestrial coverage across the continental U.S. and big parts of Alaska, is the world's oceans. That's a big piece of this because now you'll be able, not right away, but as soon as we are able to turn it on, you'll be able to get your service across the U.S. and as you travel around the oceans outside the reach of any cellular signal.
It's in beta testing right now? It's just confined to messaging?
Hundreds of satellites are in the air. We have a free beta service going on. We're starting to let people into it. Right now it's text messaging only, but fast to follow will be light data services and eventually voice.
So I can get rid of my satellite phone. We don't need that anymore?
I think the time will come when that's the case.
Yeah.
Top line growth, 4 to 5% for you guys. That's how I think about the wireless business. Is that all pricing? If so, how do you think about the pricing environment out there?
It's share taking and self-selecting up our rate card. Very little pricing. And so those are the big dynamics. Postpaid service revenue growth, 8%, more than double the rate of our peers. And so this is a dynamic that makes T-Mobile so different in this space because we're not only growing the top line, but we're translating it into financial growth on the bottom line. 25% year-over-year growth in cash flows, $17 billion, our highest ever.
Now, how do you raise prices? You sort of touched on this just briefly before, but how do you raise prices without scaring away your cult members?
Cult members. Well, one thing is people, we have a rate card with a variety of options, and people choose at an increasing rate the prices that are higher up because they want what we have to sell. Do you know that 60% of our new customers coming in the front door choose one of our 2 most premium plans? Because those are the ones that are most packed with value, and they're here for a reason. They want more data. They want the experience that T-Mobile can provide with the world's best 5G network.
Subscriber acquisition costs, how are they trending for you guys these days?
They're pretty flat, and that's good. We're very comfortable with this business model. It's a high CLV, value exchange. One of the things about this business, it's reliable, it's predictable. We do what we say. We try to exceed what we say, and it's growing. And that's one of the things that really distinguishes us in a group of peers, not just in the U.S., but around the world.
There is a Fed meeting today. Can you tell me how, if at all, rates affect your business?
Well, we're a big debt issuer, so obviously it's relevant in the long haul.
What's the debt right now?
With 2.5 leverage against EBITDA, so it's very significant. EBITDA's in the 31, very significant debt, but it's also a stack that's investment grade, it's long term, it's spread out, so it doesn't affect us in an immediate way, but in the long haul, of course, as a debt issuer.
Where would you like that leverage ratio to be?
Right where it is.
Okay. Market structure in the wireless business, 3 main players. Okay. Is there room for a 4th? And I think about my old friend Charlie Ergen. For the last 15 years, I had no idea what he's doing with the spectrum. And I don't think the market knows either.
Well, he's operating, a major brand and Boost Mobile. And the other thing is the cable companies, Charter and Comcast taken together, who don't overlap, kind of constitute an additional carrier as well. Yeah. And, they are really growing their mobile service at a significant pace. Not as significant as us. We're the growth leaders. But it shows that this is a vibrant market with a lot of competition.
And the smaller markets, that's a big deal for you too, right?
Yeah, 40% of the country, everything that's not the top 100 markets, we call smaller markets in rural areas. It's a huge source of our growth right now.
Thanks to T-Mobile CEO Mike Sievert. We move next to the auto sector. This week, General Motors gave a better than expected outlook for profit in 2025, but President Trump's recent tariff threats have raised uncertainty about the automaker's business. As a result, GM shares dropped as much as 10% on Tuesday. And for more, we were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
Yeah, I think the stock had a nice run up last year. The management team has done a great job in actually managing investors and managing the challenges that's in the U.S. market that the other companies, Ford and Stellantis, have been facing. I think the expectation has actually ran up through last year, and we got some negative news, mixed news in terms of the outlook. The tone has changed. This is the first time that GM actually is a little bit worried about the end market since COVID.
Well, what did we learn about GM and its actual EV units? Like, were sales better than expected? Like, is the trough past?
Yeah, sales, especially in the fourth quarter, it did run up. Some of that may be some channel inventory stock building, anticipation of better sales in 2025, and that's one of the key issues. I think the investors are concerned. There's going to be a mix change. They think that increased EV sales will offset some of the more profitable truck sales in 2025. So, based on our estimates, like it seems like even their adjusted EBIT margin of 8 to 10% may be a little bit too high, and they may fall actually at the low end of that range, or maybe even below.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. Coming up, we're going to break down some key corporate earnings in the aerospace industry. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We move next to the aerospace industry. This week, Boeing reported a $4 billion operating loss in the fourth quarter. Boeing CEO Kelly Ortberg said he will realign the company around key business lines and cleave off fringe assets. Separately, JetBlue shares had a record plunge after the carrier forecasted weaker than expected revenue and higher costs for 2025. For more, we are joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We began by asking George about Boeing and whether the worst was over for the company.
Look, it seems like it's always hard to say the worst is over. It seems like the trend is definitely going the right direction. It seems like 2025 could be the year they thought 2024 was going to be. Look, I heard a lot of positive things about the manufacturing process in the call. I think that's why Boeing pre-announced they wanted to get some of the forward charges out of the way so people could focus on the message. And I think the message was the factory, especially for the 737, has restarted in the new year. It's building in the mid-20s range, going to 38. It sounded like somewhere near mid-year, which is probably before where most of consensus thought it would get. And going to end the year close to 42 is what I think I heard. I mean, management kept trying to soft pedal it to a degree. And what I heard is quality at Spirit Aerosystems improving. They're happy with it. They don't think it's a limiter. All that's positive for profitability and cash flow. Boeing should make this year a lot better than last year if it all comes true.
Where should that 737 build number be in a perfect world, George? I'm trying to gauge the 38 number, the 40 number, the 42 number versus where it should be, maybe versus where Airbus is with their product.
Well, I guess I would say if you were at the Boeing board level, would you not say it should be in the 60s, somewhere well above Airbus? Look, Boeing ended the last decade before the pandemic sort of driving closer to 60 builds a month. They have plenty of backlogs. I don't think it should be at 60 a month now, but I would expect they should be driving hard towards 60 a month as we go into the middle of the back half of this decade. That's a little complex. Sorry about that. But, the 27s, 28s, I think that 60s ought to be a number they'd be looking at given the backlog. And look, where should they be right now? Maybe they should be, close to 50. So they're halfway to the level they probably should be at right now. This is the moneymaker. This is the one they want to really optimize.
Yeah. No, I was going to say, it's always like, at least it could be worse, I guess, right? Because it has been worse, so there's something there. I do want to switch and talk about JetBlue for a second, because Paul and I are just really confused as to the extent to which JetBlue is getting beaten down. We know the costs were higher than estimated, but what do you make of that price action?
Yeah, so I think they're look, the big full service carriers I think showed slightly better results than we had expected, right? And so I think if you were looking at the entire airline space, you could be confused that those better numbers would carry through to the economy carriers, to the more basic economy carriers. And I think what JetBlue told us, it didn't, right? JetBlue lives in a really difficult part of the market. They are, they're low cost, plus they have some premium seating. And I say low cost, but their costs are not as low as like a Frontier, a Spirit, and a Allegiant. And so we think at the bottom of that market in the basic economy world, your best advantage is to be able to deliver seat miles as cheap as possible because you're getting customers on price. Where if you're up in the United American, right, Delta world, you get people on loyalty programs and premium seating and things like that. We know the back end of this business is really competitive, and it's hard for like the JetBlues and Southwest to survive in a world where you got to just deliver the really cheapest seat price, and they're having a hard time doing that given the upstarts. And when they show us an 8% increase in cost per available seat mile in 1Q, no operating profit, that gets concerning that the worst isn't behind us on, excess budget seats in the marketplace.
Can we get some consolidation in that lower end of the market now with this new administration, George?
Look, we could. I think the bigger ones couldn't. I think JetBlue could consolidate somebody underneath them or somebody about the same size. I don't think they'd allow Southwest to go out and buy somebody, but I think you could at the bottom end. Plus, you have some that are hurting, right? You have Spirit Airlines. Question is, can they survive? That could take some capacity out of the marketplace. The challenge is the planes don't go away. They're built, they're aluminum, they last 30 years. Someone gets the airplanes. Where do those airplanes go? Do they go out of market? Do they go in market? But you could get some consolidation too.
30 seconds. RTX, you cover some of the defense guys. RTX doing well?
Yeah, they showed some nice numbers. The guidance for next year was nice as well. Look, they have a lower, view on how much original equipment deliveries they'll make next year than I think is probably practical, especially given what Boeing said. So they kind of look for mid-single digits growth in that original equipment deliveries. I think Boeing and Airbus alone with narrow-body deliveries are going to be 12-ish%. It'll be interesting to see how that plays out because the more that original equipment they deliver, the more pressures margins.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. This week, we focused on a Bloomberg Big Take story titled DeepSeek Challenges Silicon Valley's Assumptions About AI Costs. You can find it on Bloomberg.com and the terminal. The story looks at how Chinese AI startup called DeepSeek released a new open source AI model called R1 that can mimic human reasoning. And the release sent shockwaves through the U.S. tech industry, with tech companies analyzing how DeepSeek built its chatbot and whether it did as cheaply as it claimed. For more, we were joined by Rachel Metz, Bloomberg AI reporter. And we first asked Rachel what the feeling is in Silicon Valley after the latest news.
We're hearing a bunch of different things. I mean, I think some people are a little alarmed, a little bit surprised, but I think there's also a lot of excitement, frankly. I mean, some of it may boil down to sort of what your goals are, what your job is. I think you're seeing a lot of interest and excitement from, such as from companies that sell these AI models to other people, like sell the usage of them, like company like Databricks or Cohere. I think they're really interested in seeing where this goes. Databricks CEO told me that they have a ton of customer interest in using DeepSeek. So that's really interesting to them from a customer perspective. But you could also see how companies that are making these models might be like, wait a minute.
Yeah. Well, and I guess the question is, how soon can Silicon Valley replicate the model that DeepSeek created?
Well, Hugging Face, which does a wide variety of things, including deploying their own models, hosting other people's models, stuff like that, they're doing it right now, actually. So they were replicating it and making it available to people. And I think they're going along at a pretty good clip. So other people could be doing that as well. And that's the sense that I get that they are starting to.
You know, we've obviously NVIDIA and other chip names took just a huge hit. And I guess that kind of calls into question, investors are questioning, do we need this much spending? If somebody can come in here and do it at such a discount, how is that argument kind of festering in your backyard?
Yeah, I mean, I think that people rightfully were a little bit concerned, right? And you saw the stocks really drop. But on the other hand, you're still going to be needing chips for all kinds of things, including AI processes. And it's important to keep in mind that these AI models that are mimicking the ways that humans reason, they're still very new. There aren't that many of them at this point. They're just not very far along. So it's not clear yet how much compute, where the compute in these cases is often, you're using a lot more of it at the end of the process than you would have with different types of models. So it'll be interesting to see. It would be. One thing that's important to keep in mind, though, I think, is that a number of companies have been trying to make their models more efficient for a while. I mean, efficiency could be great. It could be great for the environment. It could be great for these companies in terms of keeping costs down. So I think that's why you see a lot of people excited about this.
Well, also, I thought it was interesting, NVIDIA's statement on DeepSeek. It was twofold. It was like, hey, they totally have complied with any restrictions on chips from the government, and they still were able to accomplish it, and we're super pumped about it. That feels like it's like, please don't put more tariffs on chips we're exporting from the U.S. Is that in the zeitgeist at all in Silicon Valley?
Not that I've heard, to be honest. I mean, there may be people talking about that, but I feel like most people are concentrating more on the idea that this company has done something that appears to be quite interesting, and they've made some really smart decisions, and they're a really smart team. And I think a lot of people just find that really fascinating, and they want to know how they can do it too.
What do you expect to hear from some of the big tech companies that report over the next couple of weeks, their earnings, as it relates to AI and kind of maybe how the ball field may be changing?
Ooh, oh, that's a good question. I mean, I'm sure they're thinking about this and looking at this. I mean, it would probably make sense to hear more remarks about efficiency, frankly. I mean, that seems to be what this company has done in a few different areas. And I would be curious to see if other companies are thinking about how they can do that. I mean, I would assume investors would like that if they're being more efficient with how they're spending money and using resources.
Our thanks to Rachel Metz, Bloomberg AI reporter. Coming up on the program, a look at why HSBC will wind down its investment banking operations in Europe, the UK, and the Americas.
If you don't have the operations, say, on Wall Street, in the City of London, continental Europe, how meaningful can you be to those types of clients in Asia and the Middle East when they want to do stuff around the world? You know, it's all very well, obviously, saying, you know, we're very big in Middle East and Asia and we'll service you there. But when it comes to being able to offer some kind of global perspective, maybe being somewhat lacking there. And I think that's going to be the area that's going to be interesting to watch here.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the municipal bond market. It's looking like a big year for munis in 2025, with investors looking at high-yield municipals to generate strong demand. For more on this, we were joined by Nora Wittstruck, Chief Municipal Analytical Officer at S&P Global Ratings. We spoke to Nora live from BAM Mutual offices in New York City.
Generally, in 2025, I like to say that the municipal sector is cautiously stable. A lot of state and local governments are coming into 2025 still sort of riding some high liquidity and reserve levels based on the COVID relief.
Still?
Still, yeah. It had, they had to commit it all by the end of last year, but they have to spend it all by the end of 2026. So they still have some in their coffers generally. And I think also just the economy has been pretty good, and that helps state and local governments and other entities that we rate in terms of the demand that they see for their services.
When it comes to something we've been talking about the last hour and a half or so, are the impact of natural disasters and the LA wildfires. Like, how do you deal with ratings and natural disasters like that?
So we bake risk into our ratings, as you might imagine, as credit analysts. But
that probably wasn't on anyone's bingo card.
So in California, the state has inverse condemnation, which means utilities, even if they are not negligent, can be liable for sparking a wildfire.
If any of their equipment is involved, even if they didn't cause it.
Yep,
right.
Absolutely. So actually, LADWP, we lowered from AA to AA minus a few years ago because they choose as a decision not to de-energize their lines relative to wildfires. And that's fine for them to do that. It's different than some of their peers in California who do that. But because of that, they decide that because they're based in an urban area, they don't want to shut off their traffic lights. They think that the risk trade-off between the wildfire and human costs are not equal. So we lowered their ratings, and I think part of that is the inverse condemnation, but also it's just the fact that utilities are particularly susceptible to infrastructure damage during a severe weather event, whether it be a wildfire, a hurricane, flooding. So it's all been baked into our ratings. The actions that we took on LADWP were partly reflecting a recalibration of that risk as wildfires have come into more urban areas versus where they historically have occurred in rural communities.
I guess in response to the LA fires, President Trump, I think, has voiced some displeasure with FEMA and even suggesting maybe some of the disaster relief responsibilities at the federal level, FEMA, be put down at the state and local level. Can states and local municipalities afford that kind of stuff?
Well, we've historically said that FEMA is an important credit support for state and local governments. These disasters are increasing in frequency and increasing in cost. And absent federal aid, that would be a significant pressure for them, and absorbing all of the costs is just probably a little unsustainable at the current rating levels. I think what we are watching for is what he actually decides to do. Does he still decide to maintain the federal aid and shift it to a block grant for states, and then states are responsible for allocating it? Or, does disaster relief go away entirely? Those are two very different dynamics that we have to monitor in terms of how it relates.
What are the different options then for those two scenarios? How would each impact the muni market?
So I think if even a lower level of disaster relief for state and local governments, right now they typically get somewhere between 70 and 90% of the costs reimbursed from the federal government.
Wow.
If that goes to 20%, that's something that we'd have to consider. If that goes to zero, that's a whole nother decision on our part to determine what the liquidity and reserves of state and local governments and entities that we rate need to maintain as a buffer against these types of disasters. Now, if it just shifts from FEMA being the allocator and the distributor of funds to states in terms of a block grant, that probably could be even like a concern for us, if you will.
All right. As a credit rating agency, you get paid to worry.
We get paid to worry.
Aside from natural disasters, which can be an overwhelming topic, what are some pedestrian things that concern you?
Well, I think generally we look at long-term liabilities, right? So pensions and how state and local governments and other entities that we rate manage their pension systems. Typically, it's managed at the state level. What does that mean? We are increasingly seeing more people retire. So how do those costs get baked into the budget? States in particular are a safety net for Medicaid, and that's something that President Trump has also spoken about in terms of modifying that plan. States get a lot of money to support people that are vulnerable and need to be in those programs. How could that change the way states function and what they need to allocate resources to? I think we also watch labor productivity and labor workforce dynamics. I think one of the things that we noted after the election is that immigration has been good for our workforce in the U.S. It has really lowered the cost and the tightness of the labor market that has turned into high increases in salaries and personnel costs for state and local governments and entities that we rate. So a major change in border security could tighten that labor market right back up, and that could put additional cost pressures back onto these entities that we rate.
I mean, on the flip side, does it actually take away some of the state aid, though, also?
So it could definitely be a bit of a boost, right? So New York City in particular with asylum seekers had to absorb a significant billions of dollars in additional costs to help those individuals as they come into the city. That could definitely be a bit of a relief valve for them if that were to change. I think, too, there could be some cost savings relative to Medicaid, relative to other social services that they need to participate in to, come survive once they get to the U.S. So that definitely there could be some offsetting improvements in cost savings relative to credit quality.
Maybe you can explain to me how life works. Florida.
Yeah, okay, let's do
Texas, no state taxes. How do they build schools and roads and things like that? Because my state, property taxes are really high.
Yeah.
New Jersey.
I mean, I own a 550 square foot condo and my property taxes are $10,000 in New York City. So I hear you on that. What happens in states that don't have an income tax? Typically, they securitize other forms of revenue. So they securitize gas taxes, they securitize sales taxes, they securitize property taxes, which is typically the way most state and local governments secure the debt obligations that they have outstanding is through property taxes. So yeah, you're right. Those taxes are high, and some of it will go to paying off debt obligations for the entities that we rate.
You don't feel good about that?
Yeah, I don't know. Why do I have to pay these high taxes? Everybody's moving to Florida to escape taxes.
It's true. No one likes paying the taxes.
Exactly.
Yes.
Well, what are some other key things that are that you guys are talking about right now, like on the desk?
Yeah, so I think, we're definitely watching federal policy. We're definitely watching how aspects of affordability cut across all of our sectors. So, I was the housing sector lead before I was the chief analytical officer, and we were watching, the lack of housing inventory and how that was affecting the entities that we rate, like state housing finance agencies and social housing providers, public housing authorities, how they're navigating that particular aspect. But it's playing out everywhere. So water utilities and public power utilities, some of which operate in LA County, we've been watching how they're raising rates to not only pay for deferred maintenance, but also for investment for adaptation to wildfires and other severe weather events. Some have been a little bit lax in doing that because it's been expensive to live in America, right? We've had an inflationary environment. We've had higher costs associated with food. We've had higher costs associated with utilities. Insurance premiums are going up for property and casualty insurance. So all of those things are weighing on management teams, and they're looking at how they can dampen those costs as much as possible.
Our thanks to Nora Wittstruck, Chief Municipal Analytics Officer at S&P Global Ratings, and to BAM Mutual for hosting us at their offices. We turn now to some news in the banking sector. This week, we heard that HSBC will wind down its investment banking operations in Europe, the UK, and the Americas. The firm will instead focus on its operations in Asia and the Middle East. For more, we are joined by Harry Wilson, Bloomberg Finance Reporter, and we asked Harry if this news was actually a surprise.
it's something that we've probably expected that could happen over the years. The truth is that HSBC has really been nowhere on Wall Street and in the city for some years now. It's struggled to even get into the top 10 when you look at sort of major league tables like equity underwriting or M&A. So the idea that they're just now kind of giving up on this thing, realizing that they can't compete with the likes of Goldman Sachs, JP Morgan, and that actually they'd just be better off focusing their resources on markets where they do have some scale, such as Middle East and Asia, makes a lot of sense. So I guess short answer, timing wise, surprise. Longer term, no, I don't think it's particularly surprising that they're taking these actions.
So, I mean, this kind of goes to me, Harry, kind of a bigger question, which is these European banks, can any of them be global investment banks? I mean, 20 years ago, I don't think we would have seen this happen.
I think it's very difficult. European banks have faced these type of problems going back decades now. Many have tried to make some kind of impact on Wall Street, and many of them have come back having spent hundreds of millions and got really nothing for their investment. The simple fact is that Wall Street is something of a lockout by the US major firms, and even when you get the likes of, say, Barclays, which was able to buy off the peg the Lehman operations in 2008, even they've struggled to make much of it. And I guess the issue is that if even a bank like HSBC, the largest bank in Europe, can't really make this thing work, then it begs questions about how anyone else, without their type of scale, without their type of profitability, could expect to make much of an inroad.
Mm-hmm. What's the opportunity set if we flip it for Asia and Middle East for HSBC?
Obviously, these are fast-growing regions, so you've got a lot more economic activity, a lot of growth coming in Asia. You've got a lot of money in the Middle East. Every day we see headlines about a Middle East hedge fund being involved in some deal or another. So these are good places to be a big bank. The question really is if you don't have the operations, say, on Wall Street, in the City of London, continental Europe, how meaningful can you be to those types of clients in Asia and the Middle East when they want to do stuff around the world? It's all very well, obviously, saying, we're very big in Middle East and Asia and we'll service you there. But when it comes to being able to offer some kind of global perspective, maybe being somewhat lacking there. And I think that's going to be the area that's going to be interesting to watch here, is whether HSBC, if it doesn't have the stuff around the world and is purely focused on Asia and Middle East, whether that is still a good proposition to its clients that in those regions that maybe want a more worldwide global networked offering.
Our thanks to Harry Wilson, Bloomberg Finance Reporter. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.